Hello, everyone. Welcome to our call, Hotels and the CARES Act. My name is Jason, and I want to thank you for joining us today. Before we get started, let me let everybody know that we are recording, and we will send the recording to all registrants. And we'll try to have a Q&A at the end if there's time. We'll address what we can. And when we send out the email with the recording, we will circulate a FAQ as well, because it's been our experience there's a lot of questions regarding the CARES Act. And with that, let me pass it over to Rod Jimenez, CEO for SHR. Rod?
Thank you, Jason, and thanks everybody for joining us. We know that this is a key topic right now as we all deal with the circumstances we're in because of the COVID-19 crisis. And so we thought that we could help out by providing information about the CARES Act, specifically as it pertains to hotels. Obviously, a lot of the information is the same information for everyone. There are a few things that are specific for the hotel industry, and so we'll highlight those things. Before we start, I wanted to make sure that you know who the main presenter here is, and that's Kevin Stewart from Briggs & Veselka. Briggs & Veselka is an accounting, tax, audit, forensic, and advisory services firm. They happen to be our auditors. They are our tax advisors, so we know them well, and we are very grateful to Kevin Stewart, who is a CPA and principal with the firm with a bunch of years of experience and has been leading the task force within Briggs & Veselka to stay on top of all of the SBA-related lending. We know that it's been a very well-received program, or much-needed program. As of Wednesday, the last numbers that I saw was that about $90 billion in loans has already been approved, and the banks are trying to deal with the volume of applications and the underwriting process. Even with the relaxation of a lot of the rules, it's still taking time, and the expectation is also that there will be probably additional money added to the pool. As we know, with government, things never move as quickly as initially expected. So we probably won't see that come through until sometime next week, given that tomorrow is a holiday, and it doesn't look like it'll be that there will be agreement on that today. So with that, I'm going to let Kevin take it from here, and then I'll come back with some closing remarks at the end. And again, thank you for joining us. And Kevin, thank you so much for taking the time to do this and helping us out as we review the information.
My pleasure. As a way of reintroduction, my name is Kevin Stewart. I am a principal at Briggs & Veselka. My primary responsibility at the firm has been, I have been an auditor, I have been an advisory, but my sole responsibility right now is within leading the client accounting services team as well as technical advisory. And so we serve as the outsourced accounting function for many companies in all range of sizes. And then separately for the technical accounting implementations, whether it be revenue recognition or lease accounting or whatever else is coming down the pike, that's been my responsibility. And as of 2 weeks ago, I became an SBA expert. And so over the last 2 weeks, it's really been diving in deep, and I'm trying to understand with the team and how can we best service clients and how can we understand. And frankly, it's been a moving target. As it first rolled out, it was based on intentions to get money to small and medium-sized business owners. And then as it's progressed, there's been more and more guidance that's come out. And I think that's kind of, even yesterday, there was more information that came out. Let's see if I can work these slides here. I apologize if there's a slight delay. And Jason, it may be easier if you control the slides here. I apologize for the confusion here, but it's not working for me. So the disclaimer here is there is no legal, this is not legal advice. This is based on our best understanding at this point in time, based on our understanding of the legislation. And really it's up to y'all individually to make your own decisions, but we want to provide you as much accurate information as possible, but know that some of this information may change. If we get into the programs on the next slide, really we had 3 phases of what Washington is attempting to do. Initially, what we call phase 1 was really around pushing back the tax deadlines, as CPAs were being pushed home, and we're all working from home. It seems like those deadlines are pushed back to July 15th. And then phase 2 became with the $1,200 stimulus payments. At least I'm calling it a stimulus payment, which still has been received by people, is to get money in the hands of people just to assist with some of the burden. And then phase 3 was really the focus of here is the CARES Act. And there's a lot of different components to the CARES Act, but the one we're talking about today is really around 3 different programs. And on the next slide, we talked about the programs are, I believe, the PPP, Paycheck Protection Program, which is primarily most of our focus here today, the Emergency Economic Injury Grants and Economic Injury Development Loans, which have been around for a long time, but there's a grant component to it now, and then the small business debt relief. But on the PPP specifically, it's all this really, in my estimation, is a cash flow program. It's making sure that business owners have money, but that they can then pass it along to their employees, which the employees can then buy groceries with, or pay their bills or do what they need to do just to maintain over the next 8 weeks, which is at least the initial estimate of how long this is going to take. So these cash flow or these loans for the PPP are 100% guaranteed by the bank or guaranteed by the Treasury and Small Business Administration. And they're also 100% forgivable if they're used on certain conditions, if they're used primarily on payroll and a few other things, which we'll talk about in a little bit. So really in this program, it's reduced, as Rod had mentioned, they've reduced the threshold of review that the banks are having to go through because there's just an eagerness and urgency to get this money out to people who are in need. Secondarily, when we get to the emergency, the EIDL, which we refer to here as EIDL, on the EIDL loans have been around for a long time, but generally they've been associated with property damage or true economic, well, not true, but economic disasters caused by hurricanes or tornadoes or some sort of act of God that has occurred. This is the first time it's ever been applied to a pandemic in the U.S. But as part of this program, part of the EIDL that they've included here is a $10,000 grant. And so the application for that, which we'll get into in a little bit, is through the SBA, and that payment of that, once it's approved and kind of gone through, it's paid within 3 to 5 days. And that $10,000 eventually reduces what's forgivable because this under the PPP. The small business debt relief is if you currently have a small business loan and you had a small business loan prior to this event, the February 15th, those principal and interest payments are being made, not delayed, not pushed, but they're being paid by the SBA and the fees for up to 6 months. We get into a little bit more detail on the next slide, where we start getting into the PPP a little bit more, is the comparison between the 2 loans and really which one is best for you and what are the key differences. And so the payroll protection or paycheck protection is truly focused on payroll expenses, employee salaries. Now, what that can be used for is also on that left side is mortgage interest, rent, utilities. But the loan itself is based on 100% based on your payroll expenses. Now, the proceeds can be used for those things on the left. On the right, the economic injury disaster, they tend to be more towards fixed costs, right? So it could be payroll, it could be AP, it could be just the things to keep the ball rolling, kind of moving on. So it's not specific necessarily to payroll protection. The amount covered or what's the maximum loan. Under the payroll protection, it's 2.5 times your business payroll or your monthly payroll. And that's an average of the previous 12 months. And that 12 months could be either through 12/31 or it could be 3/31. And we'll talk about that a little bit more. On the idle loans, it's up to $2 million. Percentage rate, 1% for the PPP, and then for the percentage for the idle would be 3.75. Kind of get to the loan terms that on the idles 30 years, the payroll protection, there is payment deferment for 6 to 12 months, but that loan is payable over a 2-year period. If it ends up becoming a loan, right? So if it's not forgiven, it becomes a 2-year loan. There was an allowance for up to 10 years, but when Treasury interpreted it, they said 2 years is the right amount. As far as forgiveness, 100% of the PPP, again, if certain criteria is met, and under the idle, it is truly a loan that's payable up to 30 years. There is no forgiveness associated with it. You can refinance an idle loan under the PPP during this program. So you could transfer that, so then it would be forgivable, at least if you spend it on the right things. And then lastly, where to apply. When you're using the PPP, you're actually going through a bank, and it's an SBA-approved lender. That lender base has increased, and they've opened up to community banks and others who weren't previously SBA lenders to really to spread the wealth a little bit more. And separately, just the sheer volume of applications coming in has been overwhelming. We service a small bank, or we do services for a relatively small bank here in Houston, and they had 1,300 loans over the weekend. And this is a bank that probably has 6 locations. It's not a national, but through 1,300 applications. Look at Bank of America. I think they were overwhelmed with applications. Wells Fargo was the same. So really the seeking of funds for this program has been overwhelming, and it probably shouldn't be surprising to us. When we go to the next slide here, we get into a little bit more detail on the PPP, which is $350 billion was assigned to this. I think it's 349, but 349 to 350 billion has been assigned to this. It's 100% fairly guaranteed loan, so there is no reason for a lender not to lend back, and the loans are forgivable. As a summary, we kind of addressed that. If we go to the next slide, we get into just a tad bit more detail here, where, excuse me, the eligibility is defined, and all this process through the borrowing. There's a lot of pushback to the borrower to certify themselves. And the verification by the bank is, we'll say, limited. There's not as heavy of a review as a standard loan, because these are federally guaranteed. And so with that, as far as the eligibility as it's defined in the application, for most instances, it's employers who have 500 employees or less. And outside of the hotels, it could be more, it could be less, depending on the specific industry. But it's not for an entire company. It tends to be on a location basis for certain companies. So restaurants specifically, hotels specifically, the 500 employee threshold is generally assigned to a specific location. It does require that the business have been on operation as of February 15th. So this is not intended for brand new startups. It's intended for businesses who had employees prior to the COVID-19 hitting and having the impact that it had. So really the intention is it's for business who've been in operation, who've had employees with payroll. So companies who are sole proprietorship. So if you happen to be a hotel where you're operating as a sole proprietor, you can still apply for this loan. It opens up the doors to you. Same thing as for independent contractors. I think the rest of these points I don't think we'll necessarily cover. They're not overly applicable. So if we go to the next slide here, we get into the acceptable use of proceeds. So again, as these are intended for payroll, at least 75% of the refundable amount, or the forgivable amount, has to be for payroll specific. And that payroll could be payroll costs, could be healthcare benefits. But it does allow for, in the calculation, it's 2.5 times your average payroll. And that 0.5 addition allows for payment of mortgage interest obligations. It's not the principal piece of it, but it's the mortgage interest. It could be rent obligations, and that rent obligations, to our best understanding, is related to all leases. So it's not just leases on a property. It could be leases for a vehicle. It could be leases for equipment. And so to our understanding, it's based on a signed lease agreement and utility payments, and then interest on other debt obligations. And again, it's incurred prior to February 15th. We can go into a little bit more detail here. And we have, excuse me. We can go to the next slide, Jason. There we go. So the maximum loan amount. And so the calculation, when you get the application, is pretty straightforward. It's a 2-page application. And really, when each bank is a little bit different, and yet the application is the same in every single one. And so on page 1 of the document, it's your basic information, and you go about a quarter of the way down, and then you have, it's what's your salaries, what's your payroll for the period, and then you're multiplying it 2.5. And so supporting that payroll cost would be salaries, wages, cash tips, any vacation time, healthcare benefits, retirement benefits, and then any state and local tax assessed to payroll. The things that you would exclude would be any compensation greater than $100,000 for an individual employee. So if an employee made $101,000, the first $100,000 would be included in the calculation. The remaining $1,000 would need to be excluded. Payroll taxes, income taxes on the employer side would be excluded. That's not directly related to the employee's payroll. And then any compensation of employee whose residence, permanent residence, or principal residence is outside of the U.S. And so if you have an employee that there is a verification, or at least a self-certification verification, that the employees that you're including in this are they are housed and their principal residence is in the U.S. And then qualified sick leave under the CARE Act, the Family's First Coronavirus Response Act, which I believe is in phase 2 of this program, or phase 2 of the Congress's response. There's a tax benefit that can be taken under that. And so there's no double dipping necessarily. So that's the intent. And so where you get to from all that is what your payroll costs are. And so the maximum loan is $10 million. The lesser amount is 2.5 of your payroll. If you happen to be a seasonal employer where most of your business is occurring in a certain time frame, there is a calculation related to, or it's taking consideration your average payroll cost for that specific time period, for that 3 months. And then that's how you're kind of getting to what your answer is. If we go to the next slide here. So loan forgiveness. And the loan forgiveness we have an understanding of, but not all the guidance has come out yet. So the calculations, the information, but through all of this, there's been more information shared kind of piecemeal along the way. But a borrower is eligible for loan forgiveness, and it can't exceed the amount that you borrowed. If you borrowed $1 million, $1 million is the most that can be forgiven, even if your payroll costs are double that amount. So payroll costs, the loan forgiveness is going to be based on your payroll costs for that 8-week period. It's going to be based on your interest on your mortgage obligation for that 8-week period. I'm going to say cash paid interest on that 8-week period. It's going to be based on your cash paid rentals cost on those lease agreements, cash paid payments on utilities, and cash paid with tipped employees, additional wages to all that. It's really cash based, or that payment is being cut and sent out. So it's a lot of questions about how do you manage that, and can you pull forward some of your costs. And I don't believe that that's the intent of it at all. I believe it truly is what are your costs during that specific 8-week period. So those real costs. And again, your loan forgiveness cannot exceed the principal borrowed. If we go to the next slide here, I think we get into some calculations, if I'm not mistaken, or that's 2 away. So it's an example here, and this is a very simple example. I'm not going to guarantee that this is 100% accurate as far as the calculations, but we're just kind of going to go with it here as far as kind of get a feel. So in scenario 1, in each of the instances, the payroll is the same. Rent goes up a little bit. Debt costs are a little bit different, but the calculation on payroll is the same. So the maximum borrowing you can have is $250,000 in each of those instances. When you get to the forgivable calculation of it, so for real cost, and I've doubled the cost here based on fixed cost. In each of those scenarios, the costs have gone up just a little bit more each time, depending on the situation. But in each instance, you can see where the maximum forgiveness is $250,000. And so that remaining balance in scenario 1, that $24,000 is forgiven. So there's nothing to pay back. You spend on the right things. You send in the right package. The bank has agreed to it, and you're all good. In scenario 2, you've matched exactly what you've spent to what you borrowed. So there's nothing forgivable. There's no loan. You kind of move on. But in scenario 3, you can see where your spending is greater than what your maximum forgiveness is. And so in that specific instance, that $30,000 that was an additional is truly just an expense to the business. There's no additional treatment. There's no forgiveness. There's no anything. It's truly just expense that you incurred, and you just kind of move on. So that loan amount of $24,000 in scenario 1 is paid back over a term of, or not scenario 1, but in scenario 3, is paid back in a period of over 3 years or 2 years with a percentage of 1%. And again, some of that payment can be deferred for up to 6 months, but the clock starts at a certain point in time. We'll go to the next slide. So you get into the forgiveness adjustments, and we're gonna scan over theirs kind of quickly because we think some of this may change. But the basic calculation is it's taking the payroll cost for that specific time period, for that 8-week period. You're multiplying it by your average full-time equivalent per month for the 8 weeks beginning on the loan origination. So if the loan is originated on March 31st or April 1st, well, it wouldn't start on April 1st, so we'll say May 1st. Then based on your average FTE at that point in time, then you calculate that and divide by either option 1, and option 1 is for seasonal employers only. And we're just going to skip that and go to option 2. So the option 2 is you're dividing it by your average FTE employee per month from 1/1 to 2/29/20. And so by going through that calculation, if for an instance, because the intent of this program is to maintain payroll, it's to maintain the cost, it's to maintain the head count, it's to maintain all that. Naturally, you have to make your own business decisions. But from a forgiveness standpoint, the intent is to maintain payroll. And so by doing this calculation, what they're doing is trying to see what was the reduction in staff during that time period. And so it's once based on that reduction in staff, then there'll be a reduction in forgiveness. Kind of get to your answer as far as how you're discounting that forgiveness amount. And you would provide this additionally to the bank specifically for their review to approve of the forgiveness amount. Go to the next slide. I believe we have another calculation. So again, the forgivable amount is reduced if there's a greater than 25% reduction in wages paid to employees. So again, you're taking the payroll cost. And then for any employees who did not earn during any pay period in 2019 wages at a rate more than 100K, amount of any reduction in wages that is greater than 25% compared to the most recent full quarter. And again, that's you get down to your reduction of the forgivable amount. And again, these last 3 slides, I think there's still some uncertainty here, but this is again based on what we know. So some other highlights, and again, this is kind of just a reaffirmation of what we discussed, is the loans are fully guaranteed by the U.S. government. We have seen some banks have their own really special qualifications on who they want to interact with, who they want to lend to, and I would say that's risk-based. I would say generally advantage or privilege is given to current borrowing customers with the bank, but it's not in its entirety. In most instances of what we found, it's just you're getting in line. You're taking a number, you're making the application, and it's really just going into a portal to be reviewed as soon as they get to it. For the application, there is no personal guarantee required, so you do not have to sign, I'm going to guarantee this loan, unlike some other SBA loans. There is no collateral, so you're not putting up your properties or anything else to support the loan. There's no, if you pay it off early, if it does become a loan, if you pay it off in 6 months, there is no prepayment penalty. And the nonprofits are included in this as well, which is I would assume it's irrelevant to hotels. We go to the next slide. So there was some. This is just calling out the interim and final rules and what they've gotten to. So independent contractors, if you do hire and have independent contractors who work for you, in previous guidance it was unclear, but they have come back and said no, it's truly just your payroll. The independent contractors themselves can go and apply directly with the SBA, so they're excluded from your payroll cost. The interest rate, I think the final number out there has been 1% on the interest rate, so it's pretty low cost to borrowers. Maturity is 2 years. I think there's still some debate and some questions about it. Is that really the right number? And are you penalizing businesses? But regardless, 2 years is the time. Payment deferral, 6 months has been defined, and then forgiveness allocation, it does specify there a little bit more about not more than 25% of the loan can be related to non-payroll cost. A few more interim rules on the next page for updated information. So the application process for a PPP initially was through an SBA-approved lender. Now that is expanded to pretty much all banks, but that bank specifically has to file an application to be approved to be a PPP or an SBA lender. And so those banks, to qualify, they have to have borrowings up to $50 million in loans for the prior 12 months. And so I would say that's a relatively small bank, but still it is verification. The affiliation rules. So if you have multiple companies or company structures and there's some different affiliation rules, it is still unclear. And so the SBA has intended to promptly issue guidance promptly doesn't mean a week, apparently. And so it's gone on a little bit longer than that of defining what those affiliation rules are. So excluded payroll costs, where the updated guidance was federal employment taxes imposed or withheld during the period of February 15th to June 30th, I believe, are excluded from payroll cost as well. And that's really when all this assistance has started coming down from Congress. That's kind of how they defined it. Next slide, please. All this information that we provided in the previous few slides, it's really as of April 3rd. I believe there were some updates that came out even as early as yesterday. I think on the information we presented here, I don't believe anything has changed significantly, but there have been changes even come down as recently as yesterday. And so again, this is based on our best understanding at this point in time. But I would encourage each of you to seek out assistance from the bank to see what they specifically desire and need from you. And then separately, just become very educated on your own in addition to what we're providing here. On the next slide, I think we start moving into more of the idle discussion as far as some links as our continuing your information gathering. The application form there is at that first link. Also, in whatever bank you interact with, more than likely they have an online portal where you're doing the application process, and it's become very non-personal. Frankly, that's even the smaller banks as well. It's become non-personal. It's all online. They direct you to all online. There's not much personal interaction. If you have a significant relationship with your bank and you are a significant client of the bank in their estimation, then you might get some white glove treatment. But generally speaking, it's an online process. On the EIDL loan, which we're getting ready to talk about, that application is directly through the SBA, and that's a link directly to the SBA site for the EIDL loans, which we're going to talk about here in a little bit more. And then the debt relief, again, at the bottom link is some very good information. I think the next group of slides, we're kind of getting more into the EIDL. So the PPP may be the right choice for you, but in instances where maybe your payroll isn't high or you have had to do some layoffs because you're just not getting the volume of guests staying at your hotels, the EIDL might be the appropriate loan. Now, one of the key variances between EIDL and PPP is forward-looking, right? We don't know what the impact necessarily of the COVID-19 is going to be. We don't know how long we're going to have to stay basically housed in place and not be moving and taking vacations and doing all those fun things, visiting family and staying in hotels. And so it's really forward-looking. It's the damage that's going to happen. The EIDL loans are really related to what's happened to your business. And so prior to this, prior to March 15th or February 15th, the average people staying in the hotel was significant. And then immediately after, a period of a few weeks after, you're having very few people stay. I think it would be very easily able to equate, this is the damage that we incurred because of COVID-19. You can compare that to prior years, you compare it to prior months, just showing some sort of information and flow to show the damage that has been incurred. And so then based on that, then you would apply for the economic injury that you have suffered at this point in time. And then it's up to $2 million. And so that application process, it's a $10,000. You go to the SBA site, you apply. It's truly a 10-minute application process to get it started. And so in that application process, it's the basic information of your business, your key information. It's the revenues for the prior year. It's the cost of sales for the prior year. And there's some self-certifications about you have incurred damage, right? You're verifying that. You do qualify under SBA. And there are links that kind of taking you out to the SBA site to kind of put those qualifications of an SBA. But at the very last slide the very last page of the application, it says, do you want an emergency grant of $10,000? And you put in your banking information, you click yes, and you pass it on. Now, the SBA, from my understanding, has been traditionally very slow, and they make the Department of Motor Vehicles seem very fast. But theoretically, they're supposed to have a response of something back within 3 to 5 days, at least on the emergency loan part of it. Even if you do not get approved for the EIDL loan itself, it is possible you could receive the $10,000 grant. Even if you get approved for the emergency loan and you decide you don't want to take an EIDL loan, you don't have to repay back the emergency grant of $10,000. So the advance does not have to be repaid under any circumstance. And it can be used to pay employees, pay for sick leave, and then the other things we kind of have listed there. So again, unlike the traditional, historically EIDL loan, the CARES Act waives the requirement that you be able to obtain credit elsewhere. So this has always been a little bit of a last resort type loan. So you don't have You may not can't get access to a line of credit. You might not be able to get access to additional debt, and so then they allow you to go to the SBA to get an EIDL loan. In this instance, they're not mandating that. They're trying to expedite the process. The next slide, we get a little bit more into the EIDL loan, and the specifics of it is really the key differences. Again, is the EIDL is non-forgivable. If you're borrowing, it's debt, but it's a low interest. It's up to 30 years, and so it's a reasonable payback period. PPPs are forgivable, as we noted. EIDL, again, the emergency grant is not. It never has to be repaid, no matter what. If they give it to you within a period of 3 to 5 days or a week, whatever it is, that hits your account, you do not have to repay it. There is no automatic grant under the PPP, but it is 100% forgivable if it's approved and you follow through on spending on the right things and you're able to support it. And again, the application for the EIDL is directly through the SBA at that specific link there. The PPP is through whatever lender that you choose to use. I think a little bit more on the EIDL on the next slide. We have, we go to the Small Business Debt Relief Program. And really, again, the simplified version here is if you have an SBA loan prior to the February 15th, the SBA will cover all low payments on your loans, including principal, interest, and fees. Again, it's not deferral. It's not adding on 6 months at the end of the loan for additional payment. It's just being waived. So it is a benefit. And so this relief will also be the new borrowers. My apologies. So it's not just about February 15th. So anybody who takes an SBA loan over the next 6 months during this time period would also be covered. I think we start to get a little bit more of a summary here in the last few slides. So bring it all together and which one is the right for you? You know, which lending program is the right for you? What process is the right for you? And starting from the bottom up, the Small Business Debt Relief Program, that's for everyone who has SBA debt, and that one makes sense. I think that if you have an SBA loan, there's no reason not to take advantage of that. With the Paycheck Protection Program, you know, we've had a lot of clients that we've interacted with. You know, maybe they're in the real estate business, they don't have a lot of employees, and maybe it's not really applicable to them. But if you have employees and if you have ongoing, you know, payroll that you're trying to maintain and manage, then it makes sense to take advantage of because there is a forgiveness piece of it. However, saying that, you know, some things to consider is during this time period, is your business going to be able to maintain employees, or are you willing to pay employees for effectively not doing any work, right? Are you going to maintain them, keep them on, just to kind of keep them on the payroll to pay so it can be forgiven for the goodness of that employee? And that's something for everyone has to evaluate and be able to do from the forgiveness aspect of it. And if you don't use it for those things, you know, is using it for those other fixed costs, the non-approved costs, you know, worth it for the loan aspect of it? Something to consider. On the EIDL loans, the economic grant, it just seems to make sense that to get that money to that $10,000, it just makes sense to apply for it, in my opinion. So there's no reason not to go try to obtain it. Now the loan itself, that's really on a business by business basis. If you have very few employees, or if you have significant costs, or if the damage has been tremendous and you're able to support it, then an EIDL loan, it makes absolute sense from a low-cost loan for over a period of 10 to 30 years, depending on the need. And based on the injury, that may make sense as you start to ramp back up your business. Again, for you individually as a business owner to evaluate. But it does, I'd say the benefit between this and the PPP program, if it is truly a loan, is it allows for a longer term than 2 years. It allows for a term for 10, 15, 20, 30 years, depending on the size of the loan. There's also greater access to it. If you have few employees, but your costs are significant, then that probably makes sense to go to the EIDL loan as well. Now, the EIDL loan specifically for each of these things, the funds can be obtained from multiple programs, but they cannot be used to cover the exact same expenses. So specifically, if you were to be approved for the PPP and for the EIDL loan both, that the funds for those programs cannot be used for the next 8-week period of payroll specifically. So again, that there's no double dipping, there's no double use of funds. Those funds that have to be separated. There is a bookkeeping aspect to this. Now, if you look into the details of the EIDL loan, if you use the loan proceeds for items not specifically identified that they can be used for, there is a penalty of 1.5 times of the loan itself, and it's supposed to be payable immediately. And I'm guessing there would be penalties associated with that if it's not paid immediately. So again, if you go to the SBA website and you can look at the EIDL loans, it does kind of walk through the details, the specifics. It is something that would be, I think, makes sense if you have significant costs beyond just payroll. Next slide, please. So the anticipated application information, and I say anticipated because really each bank is a little bit different. But there does require good faith certification that the loan is needed to continue operations over COVID-19 emergency. Frankly, a lot of this, there's uncertainty. How long this is going to go on? Maybe you're a business that doesn't have much debt and you don't like the idea of borrowing more, and so but to maintain your cash in the bank and other things, that I think we can easily say that we're uncertain about the impact of COVID-19. So there is a good faith certification that it's needed. There is good faith certification that the funds are going to be used to retain workers and maintain payroll and to pay the mortgage, lease, and utility payments. Good faith certification that the application, you don't have any other applications for the exact same programs. You cannot go to multiple banks. You're not supposed to go to multiple banks and make an application to get paid for the exact same thing. You're precluded from doing that. And then lastly, you're not receiving duplicate amounts from the EIDL or SBA disaster loan to pay for the exact same thing. There's some additional anticipated application information on the next page. When you're providing your application to the bank, and because it is based it is based solely on your payroll cost, right? What they're going to request is supporting information. So it's going to be your payroll information. If you're using an ADP or Paychex for your payroll services, each of those companies have created a pretty good payroll report specifically for the PPP program. And so whether it's individually just running it on your own, going out and grabbing it, or requesting your payroll provider to prepare the loan for you, it does pull in the right information for you for the most part. But it may be also providing W-2s. It could be reporting your quarterly state unemployment insurance, 990s, and some other key tax information that can use to support your payroll. I always say for companies in the range of 0 to 50 employees, this is a pretty quick process, and this can be done within a period of half a day to pull in that information. If you have a lot of employees, 100 plus more, then naturally it becomes a little bit more complex in pulling out certain key information. 1099s are not included in payroll. It's included in here because of independent contractors can't apply on their own. So if you have independent contractors working as cleaners or whatever else within the hotels themselves, they would need to apply for the application for this loan on their own. And again, other supportable costs. With anything else, so like if you're applying for a loan, or if you're, as an auditor, CPA, and then I think we may have some tax people online as well. When you're preparing a tax return, you're preparing an audit, it's very nice to have a very clean package of information. It gives comfort to whoever's reviewing it. So the more clean and understandable and traceable of your application back to supporting information, the faster it will go through the review process, the faster it will be approved. Because of the number of loans and because that are being submitted and reviewed, the cleanness of your application is, I believe, is critical in getting it through quickly. And some other information that may need to be included just for the bank's purpose would be monthly income statements. They may want some organizational documents and such, just kind of do some key checks as well. But again, the banks are trying to expedite this as quickly as possible. One of the banks we are working with, on average, they're spending about 20 minutes per loan reviewing. And frankly, that's not a lot of time to spend on reviewing information, but there is really just kind of key information here that we're looking at. Next slide, please. So I think at this point we hand over to Rod, and I think a lot of information shared there. And in one of our conversations yesterday, we were talking with SHR, and they said there's just a lot of detailed information. And from my experience, even though there's detailed information, this is critical information for business owners to have. And so there's a little bit more of an edge of your seat kind of desire to understand and learn and what's the best for you. SHR is there to help you. We as CPAs, Brigham Philip, is willing to be there to answer any questions as well, to help guide through the process. We have accumulated a lot of information. We've got a lot of questions from a lot of people, which has required us to research. And so because of all that, we want to be a resource to you as well. But with that, thank you for allowing me to present, and I'll hand it back over to Rod.
Thank you, Kevin. That was great. And I think, it's important to realize that it is a lot of information. It is it may appear overwhelming, but I think a lot of what Kevin went through and some of the tables that are here will allow you to look at your circumstances, look at your specific situation, and then decide what makes the most sense for you in your specific hotel situation. I want to reiterate something that Kevin mentioned, and it's the fact that the affiliation rules are still being reviewed, if you will, but not with regards to hotels. It's mostly with regards to other affiliation in the case of either venture capital backed companies or private equity backed companies. But with regards to hotels, that was from the early release of the guidelines. Hotels and restaurants were excluded from the affiliation rule or exempted from the affiliation rule, and you can do it on a per location basis. So each hotel with less than 500 employees is can apply on the PPP program. The other thing that I'll mention, and this is where I think we can provide help other than having our eyes and ears out in paying attention to things so that we can pass on to you and doing things like what we did today. One of the communications that we received from our legal counsel, Foley and Lardner, that I thought was very important. I think Kevin alluded to that with regard to the application and the cleanliness of the application, but also they mentioned 3 steps that we can take now to avoid scrutiny later. As Kevin alluded to, 20 minutes of underwriting process, it's very little. The banks are relying on the self-certification by the borrowers. A lot of that burden is being moved over to the borrower, and that doesn't mean that we should not take those certifications very, very seriously. And so the 3 steps that we should be taking now to avoid scrutiny later is to organize, print, and keep what they call a reliance file. So what the information that you're relying on to make the application, to make the certifications that those applications are asking you to make. And that means literally getting things printed, creating a file, or at least an electronic folder with all of the information that you've been relying on, SBA information, your bankers' FAQs, everything that's out there that you're relying on to make a determination as to whether or not you can certify that you can apply legitimately under this program. The other one is to contact your local funders and counsel if it's applicable, and read the FAQs. So be in contact with your bank. As Kevin said, they're overwhelmed, but there's information specific to how each bank is handling things. So just make sure that you go to them and do it ASAP. As I said at the beginning, there are now, and it's probably way bigger than this number now, but there's $90 billion in loans that has been approved. And so that's, even smaller banks are getting, inundated with applications. And the other one, again, the third step to take now to avoid scrutiny later is to pause, confirm, and scrutinize your answers. And this goes back to, again, what Kevin was saying. Make sure that it's as clean an application as possible, but also make sure that that you scrutinize it. Don't take those certifications lightly. Make sure you pause, you review it, you make sure that what you're certifying you're confident about, and I think that it'll A, make the application go a lot quicker, but B, it'll save troubles later. And also the recording from an accounting perspective of how specifically those funds are being used becomes very, very important, because that then will have to here pretty soon be relied on for the forgiveness, for the percentage of the loan that will be forgiven. So very, very important to take care of the accounting isolation of the use of the funds that you obtain, if you obtain them. So obviously your client success manager at SHR is available to help you with some of the information that obviously in the case of a hotel is, key to prove the impact of the COVID-19 crisis. And that has to do with what we can provide you in terms of the trend that you were seeing prior to all of this, what happens after, or what happened after the crisis started, how did it impact your bookings, your occupancy levels, the ADR, all of those things are there, and we can help you with those reports. And if they're not needed for the application, I think you would be smart to make it all part of your reliance file, right? And I think that, making sure that you've got that picture today very clearly documented is going to be important now, and it's going to be important in the future. So please reach out. Again, we're not doing this because we claim to have all the answers. We obviously are grateful to Kevin and Bricks and Veselka for their expertise and the amount of effort they've gone into to understand all the intricacies of this and how the programs overlap and all of that. But we can help you with data, and we can help you obviously to be a gatherer and sharer of information that hopefully makes this whole process a little easier, and it allows us to keep employees on the payroll and sort of focus more and more on how do we move past this? What does the industry have to do to make sure that guests are comfortable coming back to the hotels, and what solutions and what proposals do we put out there as an industry to contribute to the peace of mind of a traveler that hopefully returns to a hotel soon. And so again, thank you for joining us today. Thank you again to Kevin, and I think we've got a few minutes for any questions that may come up, but if not, again, we'll share answers to whatever questions are submitted, and obviously, as Jason said, the recording of this presentation. But again, thank you very much.
Yeah, we do have a few minutes. We do have one question, and for the attendees still on, feel free to use your Q&A at the bottom of your screen to enter a question before we wrap up. Pretty sure we answered this, but let's go ahead and address it again. The question is, are you able to apply for the $10,000 in emergency cash grant for EIDL if you have already applied for a PPP?
Yeah, I think the answer is yes, although there is a timing aspect of that. And so normally, I think even on the application for the PPP, there is a reduction of the amount provided to you based on that $10,000 grant. So if you applied for a $150,000 loan, it asks you to subtract the emergency grant number from that, from what's going to be paid out or paid to you, because it is that $10,000 is automatically forgivable. Now, but in saying that, and so then it seems like step one would be to apply for the EIDL grant, and then step two would be to apply for the PPP. However, saying that, if you applied for the PPP and you hadn't got approval yet, and you didn't know on the EIDL, I would recommend personally that you would apply. You could still apply for the EIDL grant. So normally, step one, apply for the EIDL grant first and go to the PPP. But in this instance, since you've already applied for the PPP, I would still go back and apply for the grant and just see what the decision is.
Okay. Another question. Your slide on maintaining the payroll referenced using FTEs as the measurement. That's the first I've seen that reference. Most guidance I've seen references headcount. How will the plans be measuring payroll maintenance?
Yeah, and I think we use the terms FTE and headcount as kind of the same, you know, and when there's probably a little bit of uncertainty, and I didn't mention on the forgiveness aspect of it, still things are coming out. So if you have several part-time employees, well, part-time employee is not an FTE, but part-time employees may be critical to your business. And so as we have additional information come out specifically around part-time employees or full-time equivalent, then we can issue that out. We can work with kind of SHR and kind of getting that information out as well. I would say though, even if you look at the FTE number, probably does take into account part-time numbers just based on calculations. But again, once we have additional information or know more on that forgiveness aspect, specifically around FTEs or headcount, then we can push that out.
Okay. Next question.
And I'm going to apologize. I'm going to apologize in advance that if I say I'm scoping something, it's truly because there's just uncertainty. So a lot of this is what we know at this point in time.
Okay. Next question. If the $10,000 grant is received through EIDL and then an EIDL loan is approved, will the $10,000 grant need to be repaid as part of the loan?
No, sir. And in no situation is the EIDL loan or the EIDL grant of $10,000 required to be repaid. It truly is just a $10,000 grant, not a loan, nothing attached to it. It's a $10,000 grant. So it's not repayable under any circumstance.
Okay. We still have a little time if anyone has a question. While we wait, again, I want to thank Rod and Kevin both for taking the time out and imparting this during this COVID-19 mess we're all dealing with. Any more questions? All right, I don't think there's going to be any more questions. With that, we'll wrap up. Again, all registrants will get the recording and we'll circulate an FAQ along with that. Thank you again, everyone, for joining us. Thank you, Rod. Thank you, Kevin.
Thank you.